Just like life, the stock market has its ups and downs. As you're researching for helpful guides regarding stocks and investing, you've probably come across the term market corrections. Stock market corrections are like the downs in the stock market. They're usually influenced by various different factors, including the government, supply and demand, etc. Most of the time, a correction usually occurs after a rise in the stock market. It's a pretty perplexing phenomena, but it happens and sometimes without seemingly any warning. However, you can actually learn to tell how and what causes it, as well as learn to take this drastic dip in the charts to your advantage. So make sure to stick around till the end of the video to learn more about corrections in the stock market. Hey, welcome to Stock Market Mate. Today we'll talk about stock market corrections and what you need to know about them. Before we get into it, make sure to subscribe to the channel and hit the notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Let's begin by talking a little bit about what stock market corrections are. As you already know, stock market corrections are a dip. These drops occur between 10% and 20% in a major market index. Fortunately, market corrections don't really last that long, and before you know it, the market goes rising back up slowly after its fall. Corrections are usually due to a lot of factors. These include major global events, pandemics, etc., company financial performance, and the like. Although it seems like it's a big stumble considering how it occurs during a period of time where the market is at its peak, corrections normally aren't something to be afraid of because, like we said earlier, they don't really last that long. However, there is this thing called a crash, which is a lot worse than corrections per se, as they have more possibility of lasting longer and causing more problems in the stock market. Corrections versus crash. What's the difference? Now, while corrections are a drop not less than 20%, a crash on the other hand is a rapid market drop of more than 20%. This drop could potentially last longer, which in turn is at risk of becoming what we call a bear market. A bear market is generally defined as a 20% decline from recent highs. In most cases, the term is used to refer to the performance of the S&P 500, which is often considered a standard measure of the market. However, bear in mind that the term bear market can be used to describe any index of stocks, or any stock that has fallen 20% or more from previous highs. Market corrections in general can be influenced by a lot of things. It can be caused by a global crisis, such as a pandemic, for example, or it could be caused by an economic sector or industry that collapses, affecting the entire market. Despite that, crises don't always affect the market. One thing to take note of is that, although a crash and corrections are two entirely different things, in the stock market you'll often hear people refer to a crash as corrections as well when evaluating the bear markets. This happens, and it's important to know the difference between the two in order to avoid confusion. Bear market versus bull market. Though we've already discussed a little bit about the bear market, we need to take a look at this other thing called a bull market and recognize what makes the two different. We already know a bear market is a 20% decline. A bull market in general is the opposite of a bear market. A bull market is when the market recovers from the lows reached during a bear market. They typically occur when stock prices rise steadily, and they are usually accompanied by high consumer confidence, low unemployment, as well as strong economic growth. In addition, new all-time highs in benchmark indices must coincide with a rise of 20% from the recent bear market lows before a new bull market can be declared. Most investors invest in the bear market despite its risk, simply because it is an opportunity to buy more stocks at a cheaper price. It's important to keep in mind that when you invest in the bear market, you need to do it the right way in order to avoid falling into the risks. Keep long-term investments. The worst thing you can do when investing in the bear market is making unwise decisions without careful consideration. Always think everything through. This also applies to the market as a whole. Investing in and out of stock positions too quickly is the major reason that average investors underperform the overall stock market over the long run. In times of stock market turmoil, we are led to sell before things get worse. We then put our money in when bull markets occur and stocks keep reaching new highs, for fear of losing out. Investing is all about buying low and selling high, but if you react emotionally to market swings, then you're not doing it right. Hence, invest in stocks long-term instead of selling them during a bear market simply because their price dropped. More on quality. While it's true that once the bear market happens, most companies go out of business. In other words, companies with high leverage or no competitive advantages are more likely to suffer when the economy is bad, while high-quality companies tend to do better, which is why you need to think more on quality. Make sure your investments are in companies with strong balance sheets and clear as well as with long-lasting competitive advantages. Avoid timing the market. Trying to time the market usually doesn't work. If you want to invest during bear markets, keep in mind you won't do it at the bottom. Even if the share price drops a little more after you buy stocks, buy them since you want the company for the long run. Now that we know all of this, let's move on to our next point. Are corrections really a disadvantage? If you think about it, there's definitely potential there despite the prospect of risks. Market corrections, a blessing in disguise? With what we already know about the bear market and the bull market, you might have some questions like, are market corrections a blessing in disguise? Can we really turn things around to our advantage? Well, as a matter of fact, yes you can. As market corrections are often both brief and mild, they usually transform into outstanding buying opportunities rather than a time for panicking. Hence, if by some fate you find yourself facing a market correction, as we all do from time to time, here are some things you can do to handle the situation and get the most of your investment. Recognize the causes of the correction. Before taking any action, you need to understand what economic developments are causing the correction, such as long-term unemployment or higher loan defaults, or a badly reported earnings report, or some other significant factors. A change that is affecting broader stock markets could mean you need to prepare for a long-term correction or even a bear market. Create a portfolio or profile fitting with your personal risk tolerance. Make sure your portfolio is structured to match your risk tolerance and investment objectives. By doing so, you'll be less prone to make emotional decisions during a correction. Reevaluate your risk profile yearly. Over the course of your life, your investment risk preferences will probably change. Take the time to review your risk profile each year and make yearly adjustments free from market effects. It is important to rebalance your investments and maintain a reasonable risk profile. The bottom line is that corrections are a part of a normal cycle of the stock market, which means staying in the course during a downturn is the best thing you could do. Do not let panic sway your investment decisions. However, if you still want to take your chances, do so with caution and enough research as well as with a good strategy in mind. Don't just make decisions without considering the consequences that it would have in your investment. When corrections happen, always remember that it's short-lived, and when if it does happen to turn into a much bigger dip, which in turn triggers the bear market, there will likely to be a way to turn things around to your advantage. Furthermore, since corrections are temporary, selling in the middle of a decline does little to help your portfolio, and it could potentially lock in your losses. You can rather consider a correction as an opportunity to buy assets at a lower price and reap the benefits when the stock market recuperates. Well, that's about it for today. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!